On October 3, 2025, Beijing stunned the tech world with a move that sent shockwaves through the global technology industry. The Chinese government issued a sweeping order demanding that all Chinese companies immediately halt purchases of U.S.-made semiconductor chips, regardless of existing contracts or business relationships. This isn't a suggestion. It's a direct command, signaling a dramatic escalation in the ongoing U.S. China tech conflict, and raising the stakes for both sides. The move directly targets America's top chip makers, aiming to break China's reliance on U.S. technology, even if it means short-term disruption and higher costs for Chinese firms. By forcing its companies to look inward or seek out non-American partners, China is determined to build a technological fortress, investing heavily in domestic innovation and alternative supply chains. The global semiconductor market, which has long depended on international cooperation and open trade, now faces a seismic shock that could reshape the industry for years to come. For years, China has played defense against U.S. restrictions, responding to export bans and sanctions with countermeasures and policy shifts. Now, it's going on the offensive, seeking to decouple its tech future from America and chart its own independent path in the global tech landscape. This is a high-stakes power play with global implications, watched closely by governments, investors, and markets worldwide, as everyone tries to predict what comes next. China is signaling it's willing to absorb significant economic pain and uncertainty in the short term to achieve long-term self-sufficiency and technological independence. The global tech industry, once a symbol of collaboration and shared progress, is now caught in the crossfire of a deepening geopolitical showdown, with the future of innovation hanging in the balance. Beijing's latest directive marks a significant moment in a decade-long rivalry between the world's two largest economies. This ongoing struggle is not just about technology, but about global influence and the future balance of power. The United States, increasingly alarmed by China's rapid technological rise, has responded with a series of export controls and sanctions designed to slow China's momentum, most notably by blacklisting tech giant Huawei and restricting access to critical components. The primary goal is to preserve U.S. leadership in cutting-edge technology and protect national security interests, especially in the fiercely competitive field of advanced semiconductors, which power everything from smartphones to military systems. By restricting China's access to high-end chips and advanced manufacturing tools, Washington hopes to create a bottleneck in China's technological ambitions, slowing its progress in key sectors. However, China views these aggressive moves as a form of economic protectionism, not merely a matter of security, and sees them as an attempt to contain its growth on the world stage. In response, Beijing has dramatically increased investment and resources into building a robust domestic chip industry, vowing to break free from U.S. technological control and achieve self-sufficiency in critical technologies. Today's sweeping order is China's most forceful retaliation yet, signaling a shift from mere protest to actively constructing its own independent tech sphere and challenging U.S. dominance. The tech Cold War has now reached a critical juncture, with both sides taking bold, escalating steps that could reshape the global technology landscape for years to come. The immediate impact of China's order will hit U.S. chip makers like NVIDIA, Intel, and Qualcomm hard. China is their biggest market. Losing it means a massive revenue hit and likely stock plunges. The bigger threat, permanent loss of market share as Chinese firms turn to domestic or non-U.S. suppliers. Once new supply chains are built, it's tough to win back business. U.S. chip companies now face a dilemma, caught between Washington's policies and China's retaliation. Expect intense lobbying in D.C. as firms argue that these restrictions may ultimately undermine U.S. tech leadership. The coming months will test their resilience in a hostile, politically charged global market. China's chip ban is part of a larger push for tech independence. For years, Beijing has invested billions to build a self-sufficient semiconductor ecosystem, from design to manufacturing. By mandating domestic purchases, China guarantees a market for its chip makers, fueling their growth. While Chinese chips lag behind U.S. technology, this protected demand accelerates their progress. The challenge is immense. Building a world-class chip industry requires capital, expertise, and access to advanced equipment, much of it restricted by U.S. controls. Despite obstacles, China is playing the long game. betting its state-driven model can close the gap. The outcome will shape the global balance of technological power for decades. China's recent strategic move is poised to send significant shockwaves through the intricate web of the global tech supply chain, affecting every corner of the industry. The semiconductor industry is a prime example of this deep interconnection. A single chip might be designed in the U.S., manufactured in Taiwan, and finally assembled in China, showcasing a truly global effort. Cutting off U.S. suppliers creates chaos for thousands of companies worldwide, forcing them into a frantic scramble to find new partners and secure their supply chains. Swapping chips isn't a straightforward task. It often requires extensive redesigns and months of rigorous testing, leading to inevitable delays and significantly higher costs. This situation accelerates the global trend of economic decoupling, with countries and companies increasingly forced to pick sides in this geopolitical chess game. We're witnessing the rise of two competing tech spheres, one led by the U.S., the other by China, each vying for dominance in the tech world. The era of seamless globalization is gradually ending, replaced by fragmented, less efficient supply chains that struggle to meet global demands. The consequences are clear: higher prices for consumers, increased uncertainty in markets, and a fractured global economy that struggles to find stability. China's tech giants, Huawei, Alibaba, Tencent, Xiaomi, are now on the front lines of this mandate. For Huawei, already under U.S. sanctions, this is an acceleration of its push for self-designed chips. Other firms face a tougher transition, having relied on U.S. technology for years. Now, they must pivot to domestic suppliers, even if it means using less advanced chips and risking competitiveness. These companies are under pressure to support China's national strategy while staying innovative and globally relevant. Their ability to adapt will be crucial to China's tech ambitions. The stakes are high. Their success or failure will shape the future of China's technology sector. China's bold move could reshape the global tech landscape. If its state-driven strategy succeeds, we'll see the end of U.S. chip dominance and the rise of competing tech superpowers. The risk of further retaliation is high. U.S. export controls could tighten, and China could weaponize its dominance in rare earth minerals. The cycle of action and reaction threatens to spiral into broader conflict. For businesses and consumers, this means higher prices, slower innovation, and fewer choices as tech ecosystems split. The world stands at a crossroads. Will the U.S. and China find a way to coexist, or are we headed for total tech separation? The decisions made now will shape the global order for generations.